Iran Fernando, did you submit assignment?
Yes, sir.
Good, good. Sachitra Bandara?
Yes, sir. I'm with Kiran, sir.
Okay. Kasapa, did you submit your assignment? Lakshan, how are you now? You are fully recovered?
Sorry, sir.
You are fully recovered now?
Yes, sir. Yes. Good, sir.
My brain has got. Mother, Chandra Kyan Mother?
Good evening, sir. Come again.
Good evening, sir. Good evening.
Good evening, sir.
Good evening.
But his brain has got damage a bit.
Only a bit, only a bit damage.
Yes, yes. Anyway, it was not properly working. Now it had got worse. Sir, what is sir? Kata kala di brother?
Yes. You have been very busy, man.
ඔව් සර් නෑ මට ඇත්ත මම ඒක දැක්කේ පස්සේ සර් මොකද ඉච්ච WhatsApp call එක අර ලිස්ට් එකේ තිබ්බේ නෑ මම අපේ හවස් වෙලා තමයි දැක්කේ සර්ගේ call එක අද මම call ගන්න ඉතින් අමතක වුණා ඇත්තටම
So much busy, right? Very good, making money.
sir?
So much busy making money in office.
At least what is there we'll have to grab, no sir. Heavy competition, no.
I'm happy for you. I'm happy.
Thank you, sir. Sir, after you finish your class, I'll give you a call.
Right, sure.
Right, okay, sir. Take care.
Thank you.
Okay, bye.
Okay, thank you. Then the assignment hurdle is over. Next hurdle will be the MCQ exam and the final exam. We will let you know the dates. But before that, we have to finish the designated syllabus. I shall share the PowerPoint presentation. I think we stopped here yesterday. We spoke of the environment where the compliance requirements are there, the directions, and from this slide onwards, we are going to discuss about the products that are being used, or more or less this discussion is aimed at giving you more knowledge and then more charisma to introduce new products, think of new products as well. So while discussing the current products that are being used, the purpose of discussing the features of other products which are not being used and which may be practiced in other markets. The idea, the intention is to give you more ideas, more knowledge, so that you will be able to design new products and then contribute to the market. So the foreign exchange spot and forward contracts, these are what you practice on a daily basis. KYC and enhanced due diligence is a must as we discussed in the previous slides yesterday. Now, being money brokers, please don't have any sort of mindset that you are free from KYC regulations and customer due diligence regulations and enhanced due diligence regulations. Those Parliament acts and the directions by the central bank are to be followed by each and every financial institution in the country, in the jurisdiction of Central Bank of Sri Lanka. So therefore, not only the provisions of those Parliament acts and the directions and the regulations has to be followed, then the reporting requirements by the Bank Supervision Department, non-bank supervision department, foreign exchange department, international operation department, domestic operation department, statistical department, and public debt department, all those authorities have the statutory right to ask for periodical returns to verify that you all, the market practitioners, do follow the given directions and the regulations. So therefore, there is no compromise to anyone in the market. The rules and regulations has to be followed. The trade base cover customer transactions and own transactions, meaning in Sri Lanka, there is a belief that speculations are bad or should not be done. So therefore, any foreign exchange spot or forward transaction has to be trade-based, meaning the origin has to be linked to a customer position at a bank or at an authorized dealer or a restricted dealer. So that is what is meant by trade-based, and then should cover customer transactions and own transaction, because the banking institutions, the authorized dealers in themselves. Yes, any comment? Can you please mute your mic before? Thank you. Now, if you have any comment or question to ask, please unmute, but otherwise have your mics muted, please. Thank you. So trade-based transactions are welcome and the marketplace to cover. So therefore, and they are being controlled by the net open position limits imposed by the central bank, Bank Supervision Department, Foreign Exchange Department, and International Operation Department, and Non-Bank Supervision Department. To each and every entity or the authorized dealer or licensed commercial bank, or in some exclusive cases, licensed specialized banks as well, like in the case of NSB. Then also they are governed by counterparty limits. The counterparty limits are imposed mainly by the board of directors of each banking institution. The counterparty limits is to control the risk and those limits help to limit the risk profile of the portfolios that they maintain. So this is about the foreign exchange spot market and foreign exchange forward contracts. As you all know and may have experienced, for the foreign exchange spot market, there can be liberal limits because just a 2-day time period to settle the sold currency and the bought currency. But when it comes to the forward market, the longer the forward date, the lesser the limit, because any counterparty being given a larger limit in the longer term can be extremely risky. So derivative instruments only very limited in Sri Lanka, but there are the certain ground level arrangements are being made, like the swap dealer, international swap dealers and derivative association is the agreement requirements and some institution may have signed the agreement between the institutions, and then derivatives are risk transfer agreements, value derived from an underlying asset. Now, the forward foreign exchange contract also can be considered a derivative of spot market transactions. Forwards are derivatives of spots, because as the spot rate moves, the forward rate also moves in parallel terms. But there can be different degree of demand and supply to spot transactions as against the forward transactions. So therefore, although along with the spot market, forward market also moves, it may not be the exact amount of movement that the forward markets are seen along with the spot market. A physical commodity, an interest rate, company stock index, currency, or any other tradable instrument can be underlying instrument. Example, now on the treasury bonds, there can be options. On the treasury bonds, we can design a futures contract, or any investment in treasury bond can be linked to a forward rate agreement. FRAs, we'll be explaining FRAs in a while. So therefore, the underlying commodity can be any one of these, upon which two parties can agree. The two parties can agree. So the specific accountancy requirement, accountancy standards are described in IAS 39, International Accounting Standards 39, and the International Financial Reporting Standards adapted to Sri Lanka as Sri Lanka Financial Reporting Standards. We discuss some of the provisions, key provisions, where maintenance of held to maturity, available for sale, and then held for trading, portfolio categorization, provisioning under IFRS 9. Then in Sri Lanka, permitted derivative products are reference to direction number such and such on November 2006 by the Central Bank of Sri Lanka on financial derivatives. So these are the few financial derivatives that were mentioned as permitted: interest rate swaps, interest rate options, forward rate agreements, forex forward agreements for forward foreign exchange contracts, non-deliverable forex forward agreement, currency cross-currency swaps, currency commodity options. So although we mentioned these names on a broad basis, in broad terms, there can be specifically structured derivative contracts based on the underlying spot rate of commodity rates or currency rates. So continuing on permitted derivatives products, only the commercial banks with capital adequacy ratio of more than 12% are permitted to engage in LKR-based forex options. There were a couple of banks who were doing forex options. I can remember very well when we were at BOC, we did some forex option contracts. Then this capital adequacy ratio is inclusive of LKR-based FX option positions. The FX option position that are being carried out are also subject to the capital adequacy ratio calculation. That's what it means. After providing for the LKR-based foreign exchange option positions, only the capital adequacy ratio has to be more than 12%. The directions of the director bank supervision on risk-weighted capital should be followed in determining the capital adequacy ratio. Authorized dealers should ensure that each LKR-based FX option is made only in respect of risk or exposures arising from permitted underlying current transactions, which normally qualifies for forward foreign exchange contract, such as payment and receipt in foreign exchange in respect of goods and services on trade. So the summary meaning of this paragraph is that now usually importers and exporters of goods and services approach their bankers to cover the respective transaction, import or export transaction under forward exchange contracts. So the forward exchange contracts, I think, is very well demonstrated, and many of you are aware of the mechanism to cover the foreign exchange contract under the import or export transaction. Just a small example just to discuss. If you happen to import a car from Japan, then value of the vehicle invoice, commercial invoice value, shall we say, estimated 10 million yen. So then that means when the vehicle you ordered, when it arrives at the harbor in Sri Lanka, then you have to make payment after receiving the documents for the vehicle import. The documents are the commercial invoice, the certificate of origin to say that the vehicle is manufactured in Japan, then bill of lading, the proof or receipt obtained from the shipping lines who carried the vehicle to Colombo port or Hamamatsuda port from the port in Japan, and insurance certificates, marine insurance certificates. Those documents, when you receive them, the bank will endorse the bill of lading, because the bill of lading carries the title for the vehicle that is imported, and the bank is the beneficiary on the endorsement of the bill of lading from the exporters bank in Japan. So therefore, bank will have to endorse it in favor of the importer, which is yourself. After when you make the payment to the bank of the value of the vehicle. So with those documents, you proceed to the harbor customs pay the custom duties and remove the vehicle from the harbor. So in this process, the 10 million yen payment, the value is known of 10 million yen at the time of agreeing the sales contract between the shipper and yourself. You are the importer. So if you estimate the vehicle to arrive in Colombo or Hambantota port in 5 weeks' time, you will, and if you feel that the rupee is going to depreciate within those 5 weeks, and then you ask your banker to give you a forward purchase contract for yen, because you need to buy yen to pay the shipper supplier. So 5 weeks forward yen forward contract. In the case of trade transactions, retail transaction, we discussed that there can be an option period as well. So it can be 4 weeks fixed, 1 week option. Well, option 1 week. During the period of 1 week option only, you can submit the documents to the bank, request them to endorse, and then make the payment to the supplier. So therefore, the banker will have to work out the forward yen rupee rate for you, because you will be paying in rupees, and the bank will remit the 10 million yen you bought from the bank to the exporter to the given account in their bank in Japan. So instead of the forward exchange contract, what this paragraph is mentioning here is that you could very well ask the bank to give you a forward FX option contract. You can buy a call option contract from the bank, having the right to buy in at the rate, strike rate agreed upon on the yen option contract. Now, call option, as we learned the other day, call option is the right to buy, and if you are an exporter, then you have to sell, so you buy a put option. Then right to sell whatever the export earnings to the bank with the put option contract. But here, in this example that we mentioned about the vehicle import, where you have to buy the yen, 10 million, then for 10 million yen, you can structure or you can ask the banker to give you sell you a yen rupee option contract. So the bank, if they have the mechanisms and the capability and the skill to price the option, then they will tell you, the banker will tell you that you have to pay the premium, small premium, a percentage of the total value has to be paid to the bank as a premium to buy the option contract. But in the case of foreign exchange contract, there is no fee involved, but the forward yen option contract is also another method to hedge your yen rate moving against you during the period of 5 weeks. The other advantage in yen option contract is that if by any chance, after having entered into the yen option contract with your payment of premium to the bank, then at the time of payment of yen to the exporter in 5 weeks' time, if the yen rupee rate agreed upon or strike price under the yen call option contract is worse and the market had moved in your favor. In other words, you're buying yen in the spot market is cheaper in the 5th week than the rate agreed upon on the forward yen option contract, then you can forget about the yen option contract and then proceed to buy yen from the bank at the spot market and pay or settle the exporter or the supplier of vehicle. So in the case of a forward foreign exchange contract, you can't do that. It's a legally binding contract. So therefore, you have to go through the purchase of yen as agreed at the rate of forward foreign exchange contract. But with the foreign exchange yen call option contract, if that rate is not favorable to you at the time of settlement, you can opt to not to exercise the forex yen call option and ignore it, because the underlying theme of option contracts is the right but no obligation. You have the right to buy at that rate, but there's no obligation. But in the case of foreign exchange contracts, you have right and obligations both. So this is the difference. Okay. So transaction types, derivative transaction types. Under the direction of 1st August 2009, Central Bank categorize the users of derivative contracts as end users, non-market makers, derivative market maker into 3 categories. End user category is the persons who want to buy a derivative contract, either forward foreign exchange contract or a call option contract or a put option contract from a banker, and they are called end users. They do buy those option contract, forward foreign exchange contracts on their own account, but not for speculation, not to sell it to somebody else. So that category is end user category. Then the second category, non-market maker, on behalf of the bank's customer, they would quote a rate, the forward foreign exchange rate or a option contract rate, and purely to make a spread and to service the customer. There can be a reason and opportunity for the non-market maker bank to cover that exposure with another bank or market maker, because exposing just a single transaction with a customer is going to be risky. So therefore, the forward foreign exchange contract or the forex option contract can be covered with other counterparty. If you sold the yen to the customer, 5 weeks forward yen to the customer, forward contract, and the banker would decide to buy 5 weeks yen from another market participant to cover that position. But in the same way, a yen option contract, now what we discuss is yen call option contract, bank selling to the customer instead of forward foreign exchange contract, then the bank can decide to buy another call option contract from another market participant to hedge what they sold to the customer. Then the derivative market maker provide derivative trading services to customers and financial institutions and quote prices take market risk. And this category is a comprehensive market maker in that particular product, derivative product, and they must also maintain 12% capital adequacy ratio, including the capital provision for those derivative contracts. So please remember these three categorization of derivative market participants: end user, non-market maker, and derivative market maker. Inform International Operating Department and Bank Supervision Department before commencing dealing in derivative instruments. These are the requirements by the central bank. Should be based on individual transactions and not on pooling of several transactions. After having quoted to customers and various counterparties, they should not pool, aggregate the positions and then decide to cover or not. That's not permitted. What is requirement is that individually the transaction has to be covered. Maximum tenor of 10 years for these derivative products. And they can be in any currency of choice. Swaps involving upfront payment are not permitted. Should be net settled. And there are several transactions to be settled with same counterparty. You can aggregate them, sales against purchases, and then on exact value dates, and then net settled. Ensure that customers clearly understand the risks. Now, in the case of derivative transactions, the Code of Ethics by ISDA and then various other world bodies is a very clear stipulation that with whoever who you deal derivative contracts, you must understand clearly that the customer or the counterparty understand the risk of dealing in derivatives. Now, in the case of banking institutions, the other bank who wish to deal with this particular bank have the right to consider that the second bank is also possess the equal knowledge on derivative transactions. But when it comes to a individual or corporate customer, then the bank has to ensure, ask the questions, probably in writing, and get confirmation that they do know about the processes and mechanisms of derivative transaction and settlement. And most importantly, that they understand the risk side of it or the loss-making side of it. The famous crude oil option contract by the Ceylon Petroleum Corporation with a few bankers, the main accusation to those bankers was this aspect, that Ceylon Petroleum Corporation, being a government organization authorized to import, process, and deliver the crude oil import, process, and deliver the fuel to end users, it was believed that they did not have sufficient knowledge in handling financial derivatives. However, the so-called officials, seniors in CPC had given in writing that they do understand. So therefore, the blame was taken out of those banking institutions. Establish sufficient measures for analysis and mitigate possible risks. Possess institutional capacity and approval. That means the institution has the capacity and the need to involve in derivative transactions, and the approval by the board of directors or the highest authority is in existence. Obtain a prior undertaking of understanding of risks. So this is what I said about the confirmation that the relevant officials, authorities do understand the risk side of the derivatives, and that should be in writing. Bank's responsibility for derivative transactions contracted, appropriateness for the customer and the intended purposes, compliance to relevant laws and regulations. So this must be the responsibility of the banks who cater to the end users or the customers. They must ensure these points. Banks required to submit monthly to the International Operation Department statement of transactions indicating product type, amount, rate, currency, maturity, counterparty, details of underlying transactions and exposures. There are pre-designed forms or formats to fill up all this information and submit it to the IOD and the BSD, and in the case of non-bank financial institutions, the Director of Non-Bank Supervision Department. Banks are required to make adequate disclosure in their audited accounts as stipulated by the Sri Lanka Accounting Standards and the Sri Lanka Financial Reporting Standards, etc., that they have undertaken the derivative transactions and the nature of the transactions and the evaluations of such transactions. And the mark-to-market and follow accepted accounting standards. The mark-to-market values has to be also disclosed in the audited financial accounts. Banks should adapt and follow ISDA, International Stock Dealer and Derivative Association agreement with their counterparties. This is like the master repo agreement, but it is more comprehensive because it deals with the risk of derivatives. In fact, the master repo agreement also covers the repurchase and reverse repurchase agreements, which are derivatives of treasury bills and bonds. So it is a similar document. So the best compliance procedures, first of all, know your customer or counterparty, risk grading of your customers to understand and then categorize into their respective risk grades so that those risk categories can be addressed separately and then jointly, and awareness and can be measured. Awareness at business level of compliance regimes, local and international. Awareness at management level of compliance regimes, local and international. Convenient reporting mechanisms internally and authorities by channel. Convenient reporting mechanisms internally and authorities by channel. Meaning the reporting to the local authority or internal superiors, there should be convenient way of reporting the changing positions of the derivative portfolios, as well as the authorities or the regulators through a proper channel or through a proper web-based or any other channel that is dedicated for such reporting. Okay, now we begin the derivative products one by one. Please listen carefully so that you can gather the mechanism and the essence of such products, and then you yourself can think of implementing such products into our market. Interest rate agreements. A transaction between two investors in which one investor, say investor A, agrees to compensate another investor, investor B, if a certain variable interest rate known as the reference rate rises above some agreed upon strike rate. Let me give you a very simple example. Now, I'm planning to build a house and the cost is 40 million. And I'm planning to raise a bank loan. So whilst making preparation, architecture and then structural engineering and all that, and also the building plans being approved by the authorities, UDA and then urban authorities, with the bank with whom I'm going to raise the loan, I negotiate the rate of interest. And they would say 10% for 40 million loan. 10%. I will need the money through the loan. Shall we say, now we are in November, shall we say in March? In March. So December, January, February, March, 4 months from now. So now the bank indicates to me that the rate is 10%. It will be 10%. But bankers have the natural practice. If the rate changes by in this duration of 4 months, they will change the rate at the time of granting the loan. So therefore, I go to another investor who believe now for me, if the 10% rate goes up only, I'll be losing. So I will go to another party investor who believe the rate will be lower in 4 months' time. So I agree with an interest rate agreement with that investor at strike price 10. My rate is, I want to hedge my commitment at 10%. I agree with that investor that with the strike rate of 10%, if the rate goes up to 12%, that particular investor will pay me 12 minus 10, 2%. And if the rate goes down to 8%, I pay him 10 minus 8, 2%. So my effective rate is 10% in any case. So therefore, both parties, investor A and investor B, investor A and investor B are covered with their commitment or the strike price. Their cost is secured. So this is a simple interest rate agreement. So investor A makes this compensation at certain periods of time over the life of the agreement. Each time the reference rate exceeds the strike rate, the difference is exchanged. In exchange, investor B gives investor A a premium or purchase price for the agreement. And then you can see also we are going to explain about the interest rate swaps later on as a similar contract. So interest rate agreement. I'm just explaining the features of these contracts so that you can have a rough idea, and then it will give you the features of some products, derivative products, so that those features and the understanding can be used for you by you to structure new products in our markets. So next product is the forward rate agreement, so FRAs. They are more commonly used. And then I will have an example worked here. I suggested yesterday that you have your calculators ready to go through the arithmetic to understand better. FRA, forward rate agreement, a technique to enable both borrowers and lenders protection against changing interest rates. FRA is a technique to enable both borrower and lender protection against changing interest rates. Doing nothing is taking a view that interest rates will move favorably. So if you just do nothing, if you invest in a treasury bond, and then if you do not hedge your exposure, you will think always that the bond prices will move in your favor. In other words, interest rates will go down. So therefore, it may not happen all the time. So therefore, doing nothing is taking a view that interest rates will move favorably. But if it moves up and the bond price is down, then you tend to lose. FRA is a flexible risk management tool. Corporations can establish their borrowing or investment rates in advance or lock in of rollover or starting date from the transaction. FRA allows one party protection against rise in rates and the other against the fall. FRA is an over-the-counter contract where one party is usually a bank. FRAs are normally over-the-counter contract, not exchange traded, because it is the contracts FRAs has to be structured separately to the given needs of the buyer or the seller. FRA is based on a notional principle, meaning in the example that I took earlier, I was to raise a 40 million loan. So my negotiating with another party to give me an interest rate agreement or a forward rate agreement will be based on the 40 million, but 40 million will not be paid or received by me with that party. I'll be raising my loan with the bank. But the rate difference calculation only will be based on 40 million, and the difference is settled between me and that party. So therefore, notional principle is a concept to reduce risk. I'll be exposed to that party only for the commitment of the rate difference, either 10 minus 8, 2%, or 12 minus 10, 2%, one of the two. So that commitment only, risk exposure only we will have between the parties of this derivative contract. Exposure to both parties is only the difference between the agreed contract rate and the settlement rate based on the market rates at a future date. This is what I explained just now. On settlement date, one party will compensate the other with the difference between the actual market rate, interest rate, and contract rate specified. One party will have the protection against the market rate in excess of the rate specified in the contract. The other party against the market rate below the rate specified. If the settlement rate is greater than contract rate, the buyer receives cash from the seller. If the settlement rate is less than the contract rate, then the buyer pays the seller. So thereby the decided or dedicated rate will be the cost for both parties. I will have an example worked out so that you will understand very much better. Simple agreement between parties. FR is a simple agreement between parties, and flexible features including principal amount, starting dates, and interest periods. Direct settlement between the parties. Low credit exposure as both parties' liability is limited to the compensation payment because of notional principal concept. Early closeout through reverse trading the position. This is the formula to work out. Get your calculators ready. Using this formula, we'll calculate the payment that should be made by one party to the other party. The formula S is the settlement amount, the amount to be paid by one party to the other party. Calculation is A, the nominal value of the contract, or notional contract value. As I indicated before, the 40 million loan contract, A will be 40 million. And if you want to hedge a treasury bill or treasury bond of 1 million, it will be 1 million value of A divided by 1 plus D is number of days in settlement period divided by 365. If it is 6 months, 182 divided by 365. And multiplied by settlement interest rate as a decimal. Why decimal? Because we have to, if you put the full percentage rate, you have to divide by 100. So to avoid dividing by 100 only, to make the formula very simple, you put the interest rate as the decimal point. Meaning if it is 10%, 0.10, that's it. then that whole thing minus again the nominal value of the contract or notional principal, divide by 1 plus number of days in the settlement period divided by 365 and multiplied by contract interest rate as a decimal. Contract interest rate as a decimal. So when this whole value of this whole thing, and then you subtract the value of this thing, you get the value of S, which is the settlement amount between the parties. Okay, example. I use a calculator and do the calculations, please. Although I have shown the calculations here, I want you to please practice it. Mr. R plans to invest LKR 1 million in 6 months government treasury bill. From March 2021 to mature in September 2021, current rate is 6%. Rates may come down to 5%, hence Mr. R plans to sell FRA 3 into 6. So we are in January, and then March is 3 months, and 6 months from that up to September. So the FRAs are commonly, such FRAs are commonly known as FRA 3 into 6, because 3 months period up to March, and 6 months period from March to September. This is how the contracts are usually known. Okay. So the formula, I have repeated the formula here again. I have used 2 different colors, green for the first computation and red for the second computation. So the principal amount here is 1 million. So A is 1 million. 1 plus, since the period involved is 6 months time, we are using 180 days divided by 365 into decimal points of the 5%, 0.05. 0.05. And on the other side, we'll discuss that also simultaneously. Other side here, 1 million divided by 1 plus 180 divided by 365 into 0.06. 0.0, that's the contract rate, contracted rate. And the settlement rate has been 5. So when you solve these two arithmetically, you get the green value of 975, 933.48, red value of 971, 250.97. So therefore, 975,933.48 reduced 971,250.97, you get 4,682.51, and which amount Mr. R will receive from the FRA seller. I guess it's very clear to understand. So therefore, I suggest that you do a little bit of thinking and then working out after the session, maybe at home, so that you will understand. Please read the few slides prior to this and then do this working. You will definitely understand the workings and the benefit of that, the mechanism, which will help you to gather more knowledge and practice and apply to such knowledge gained to other products or to design a new product. Okay. Any question on these calculations? Do you understand? You should be reading these slides and then coming on to this calculation. You will understand how the investment of 1 million rupees in 6 months government T-bill was hedged, and the rate change, how it was benefited to the investment. Okay. Now we come up to, we discuss the FRAs. Now we will do some calculations on the foreign exchange spot rates and the forward rates. Spot rate is a value or price of one currency stated in another currency. Commodity currency first and the term currency second. Now, when you say US dollar 1 equals 199 rupees bid and 203 rupees offer, the commodity currency is the US dollar. The term currency is the LKR. But in the example here, Australian dollar, one Australian dollar is quoted in terms of US dollar. So the commodity currency is the Australian dollar and the term currency is the US dollar. And the quotation says that the bank dealer will buy 1 Australian dollar and will give away only 0.7850 US dollars. At the same time, the bank dealer will sell 1 Australian dollar and he has to be given, or he will buy for that 0.7870 US dollars. So the 20 pips spread between the buy and selling. So the last row shows sell buy here. Why? The market taker or the customer of that bank has to sell Australian dollars at 0.7850 US and buy Australian dollars at 0.7870 US. In other words, a bank, when they quote a bid, it is the selling rate for the market taker. And when the bank quotes an offer rate, it's a buy rate for the market taker. So if you understand that concept, I think that is adequate for the moment. I think it's not very difficult to understand. I think you're very well accustomed to this. So direct quotation is the value of unit of foreign currency expressed in terms of home currency. I think we learned this before. Indirect quotation is the value of unit of home currency expressed in terms of foreign currency. Now, the direct quotation example is the 1 USD equal to LKR 200 rupees. 200 rupees is the home currency. So it's a direct quotation. Indirect quotation is the quotation usually express GBP or EUR or Australian dollar. Their home currency unit is expressed, value is expressed in foreign currency. So those codes are indirect quotations. Reversing a quotation or transposing for FX spot rates. I think we learned this in the first semester. Example, when where 1 USD, the USD be made commodity currency here, 1 USD equals Aussie dollars 1.3450 bid and 1.3520 offer is being converted to 1 Aussie dollar equal to US dollars 0.7396 bid and 0.7435 offer by this formula here. 1 divided by 1.3450 will give 0.7435 and 1 divided by 1.3520 will give 0.7396 because the bid and offer changes. With the conversion, bid and offer changes. And the most important thing to learn here is that when you divide 1 by this rate, you obtain the value of the transposed value of the currency. You turn the commodity currency the other way to the other currency. So it will be very useful in an ongoing market. When you see a rate, if you want to calculate the rate of the other currency value, it can be done very quickly by using this tactic of transposing. Actively traded currency is quoted bilaterally. Where there is no bilateral quote, a cross rate may be calculated for any two currencies using a common currency such as US dollar. That's how we do when you want to find the value of an exotic currency. We find an actively traded currency pair and then work out the exotic currency value using that formula. Cross foreign exchange spot trades. Now, 1 USD equals Japanese yen 149.50, 150.40, and 1 USD equals Deutsche Mark. Deutsche Mark is not in existence now, it is euro, but just to understanding purposes, 1 USD equals Deutsche Mark 1.5650, 1.5660. And to find out the value of 1 Deutsche Mark in terms of yen, to find out the value of 1 Deutsche Mark in terms of the yen, you bring the higher value or the offer value as the denominator, offer value of Deutsche Mark as the denominator, and divide the yen by that amount, and you get a price of 95.47. And then in here, you divide 150.40 by 1.5650 and obtain a value of 96.10. So that is also explaining why we divide by the denominator higher value here, because when you arithmetically, when you divide something by a higher value, you get a lower value. So therefore, bid side has to be lower always. So therefore, one dash mark is equal to yen 95.47 bid and 96.10 offer. Okay. So that was to cover the little bit of difficult parts on the spot exchange rates. But now we are walking up to forward foreign exchange rates. I think we learned the long way of calculating the premiums and discounts in an earlier class. But please follow this very carefully. Spot market is delivery for 2 working days. That is no question about, no argument. Delivery for 2 working days. The forward market course, price quoted now for delivery of currency at a future time or date, anything beyond the 3rd working day. Forward points are added or subtracted depending on their values between the two currencies are rising or falling. Example, 1 AUD is equal to US dollar on the spot market, 0.7900 and 0.7910. And using the two interest rates of the US dollar and the Australian dollar, the forward points had been calculated at 200 and 210. So therefore, now one important factor to note here is that when the bid side is lower, 200, than the offer side, 210, it is also always understood that it is a premium. It is at a premium, and the forward rate is expensive. So therefore, you add 0.7900 to 200 points, and forward bid is shown as 0.8100. Now, because there were 3 digits shown here, you can very well understand that the 200 has to be added to the 3rd decimal point, and then answer will be 0.8100. And on the offer side, 0.7910, and the 210 forward points again had to be added to the 2nd and 3rd decimal points. 1 plus 1, 2, 9 plus 2, 1, and 1 plus 7 is 8. So please be very careful in placing these decimal points under the correct decimal point of the spot rate. If not, the values will exponentially change, and that will be wrong. So as we learned in the previous class, the forward points reflect the comparative interest rates between the Aussie dollar and the US dollar in this example. Between the Aussie dollar and the US dollar in this example. Right. I guess you understand clearly. And just to explain the subtraction or the discount market, forward discount market, if by any chance it was 210 here and 200 here, then the bid side is higher than the offer side or the forward points. That shows that is a discount. So what you do is if it is 210 here, 0.7900 minus 210 minus 210, then the forward market will be .7690. Bid will be 0.7690. Please note that. And then the offer side will be, forward point will be 200, and that has to be reduced from 0.7910. And that will be 0.7710. So in that discount market, the forward rate will be cheaper than the spot rate. And the way to decide whether to add or subtract is by looking at these 2 points. When the bid side is low and the offer side is higher, it is supposed to be at a premium. When the bid side is higher than the lower offer side, it is supposed to be the discount. It is supposed to be the discount or to be subtracted. All right. Okay. Forward market, little bit of thinking and then answering some questions. Little bit of thinking and answering some questions. Please answer these questions. I have just designed this forward points going by the premise that these days, as we did the calculations the other day, for a day there's about 2 cents premium of US dollar against the LKR. So the first column is bid and the second column is offer. 1 USD equals the LKR on the spot market, 199, and the offer is 202. Now, this is a very wide quote. Usually in the spot market, the spread between the bid and offer can be 1 rupee or 50 cents. Is it correct or wrong? I know that there are no spot transactions in the market now. But some time ago, you would have done some spot trading, spot transactions. The spread between the bid and the offer had not been so wide at all, isn't it? This is about 3 rupees spread between the bid and offer. But just to explain something, so the overnight, meaning one day, the swap points 1 cent bid and 2 cents offer. Spot 1 week, basically the 1 week from the spot date. On the bid side, 7 cents, and the offer side, 14 cents. Spot 2 weeks, bid side 14 cents, and offer side 28 cents. The forward points cannot be such wide, but however, just to explain something, I just plotted these numbers. Spot 3 weeks, bid side 21 cents, offer side 42 cents. Spot 1 month, bid side 30 cents, offer side 60 cents. So can you calculate 1 month forward outright rate? No. 1 month forward outright rate. You have to decide, first of all, whether to add or subtract the forward points to the spot rate, isn't it? As we discussed in the previous slide, when the bid side is lower than the offer side, it is at a premium. Then what you do is you add the premium to the spot rate, isn't it? Okay. So can you help me to just to write the 1 month forward outright here? 1 month forward outright. What is it going to be? 199.00. Yes?
199.00 plus 30, sir.
Yeah. So what is the forward bid 1 month here?
199.30 and 202.60.
30 and
202.60.
everybody agrees? Have anyone got any other understanding? No? So very good. Everybody in the correct side. Everybody's in the correct side. Okay. So tell me now, if any others have to want to make a comment or ask a question, please do. Now, tell me, spot 1 month buy sell swap. Spot 1 month buy sell swap. Is it a receiving swap or a paying swap? Spot 1 month buy sell. Now, this is quoted by, shall we say, a market maker. Shall we say BOC quotes these rates? BOC is a market maker. So, any others looking at this? BOC is spot 1 month. What is their receiving swap and what is their paying swap? When you say buy sell, please remember, just for your easy understanding or quick thinking, small tip here. When the market maker has these rates quoted 30 and 60, spot 1 month forward points, and to decide the market maker's quotations, when the market maker wants to buy sell, meaning he is buying the USD and selling the USD in the 1 month forward date, which is the lower interest currency, which is the low interest. That's why it is at a premium, right? It's a low interest currency. So for the market maker to part with high interest currency for the period of 1 month, on the swap points, he must receive, isn't it? He must gain. So it's a receiving swap for the market maker. And when he's receiving, he receive a higher value, 60 cents. So it's always safe to focus on the second leg, selling at the offer rate, right? Selling at the offer rate. So immaterial of the spot rate, you can base the spot rate at 199 or 202. There's no middle rate. Shall we say 200 rupees? Base spot rate at 200 rupees or 202 rupees and add the 60 cents to that. Buy, sell. Okay. And that's a receiving swap for the receiving swap. BOC is going to buy at 202 and sell at 202.60. Or BOC is going to buy at 200 and sell at 260 cents. So in other words, they are buying at the spot rate and selling at the 1 month forward 60 points plus. So therefore, it is a receiving swap for the market maker and they are receiving 60 cents. And they are receiving 60 cents. I hope you understood. And then second point, 1 month sell by swap. If the market maker wants to sell by, or on the other hand, if you as a broker, you get a requirement from another bank, another party, that they want to buy sell. So the market maker, when they have quoted this rate, they will have to sell by, isn't it? Market maker have to sell by. Now, when the market maker is selling dollars and buying forward, they are selling a low interest currency and then buying a high interest currency, rupees. So naturally they have to pay. So it is for the market maker paying swap and they will pay a lesser amount. In other words, as I said before, you should focus on the second leg, buy, and the bid side is 30. And similar to the earlier receiving swap, you can base the spot rate at 199 or 200 or 202, that's immaterial, but add the 30 points only. Add the 30 points only because the BOC or the market maker will pay a lower amount for the paying swap. Market maker will sell at 199 and buy at 199.30 by paying that 30 cents to the other party who wish to transact at these rates. Did you understand that? Then technically, what you should remember is the second leg of the buy sell or sell buy second leg. For the market maker, he will focus on the second leg. On the receiving swap, buy sell, selling side 60 and the spot plus 60 cents. And the buying sell buy, second leg is buy, bid is 30 at the spot plus 30 cents for the paying swap, because the market maker will want to receive more and pay less. That's the idea. I hope you may have already been doing this in the market, but for those who have not been doing this in the market, please understand this way. And when you do a swap next time, please see whether you follow these technical points, and then see that actually whether you follow these technical points. All right. So the spot 1 month buy sell, spot 202 plus 60 cents, 202.60. Spot is 202, buying by the market maker and selling at 202.60 by the market maker. So other counterparty has to do a sell buy at that rate. The party had to, or there's a paying swap for him. The paying swap, he has to pay more because the market maker is the king. You have to transact at the market maker's quotations. All right. I know money brokers, when there is a swap like this, they introduce another party in between and then make it 3 transactions or 4 transactions. But I do not want to encourage that. I know it is more business for you all, but I wonder whether you add value to the market that way. You understood? Any questions? Okay. If there are no questions or comments, we'll march forward. Swaps generally are private agreement between parties to exchange cash flows or financial obligations on pre-arranged conditions at certain times in the future. This is the general description of a swap. Currency swaps, agreement to swap foreign currency liabilities to mutual advantage. There is another type, interest rate swaps, agreement to swap interest rate obligations to mutual advantage. Interest rate obligations. Right. I think this diagram I discussed with you all before, but Forex forward contracts, I think that was a different context. Anyway, we'll go through once again. example here is that LKR rate of interest is 5% per annum. Euro rate of interest is 2% per annum. And the spot exchange rate, 1 euro is equal to 230 rupees. And then January 2021, January 2022, 1 year period. 1 year period. So 230 rupees is equal to 1 euro. So 230 multiplied by 1.05. Where did the 1 come from? Because it is 1 year, 0.05 is the 5% divided by 100 because it's percentage. And when you multiply 230 by 1.05, you get an answer of 241.50. So the 230 rupees will be worth 241.50 in 1 year's time because of interest at 5%. Then the euro 1 with interest at 2%, it will be 1.02 in 1 year's time. 1.02 in 1 year's time. Therefore, the forward rate is going to be 241.50 divided by 1.02, 236.76. Whereas spot rate is 1 euro is equal to 230. Forward 1 year rate will be 1 euro equals LKR 236.76. 236.76. So what is the premium here? 676, isn't it? 676 is the premium. It is the application of basically the rate difference between the 5% and 2%, which is 3%, is embedded in these two calculations. Is embedded in these two calculations. So therefore that net 3% is represented by 6 rupees and 76 cents premium against 1 euro. Against 1 euro. Why is it a premium? Because euro interest rate is 2%, rupee interest rate 5%. When a lower interest in currency is a commodity currency, it will be expensive in the forward market. And you have to add the premium. You have to add the premium. All right. Okay. So basically, currency swaps, which you explained in the previous slide, between companies like Demo and AIA Insurance or Brandix and MAS Garments, mostly this type of currency swaps are happening between themselves when one party earns rupees in Sri Lanka and should take euros to their home country or parent company, or otherwise, or between governments, the swap arrangement between the central banks is also works in this fashion. On the first date, they exchange the lump sum of the currencies for the benefit of the two parties. And on the second date, before that, on the interest payment period, they use the interest rates on the respective currencies and exchange the interest components between the parties. And if this currency swap is for 5 years, say, so at the end of 1 year, you exchange the interest component between the party. They pay 2% to this party, they pay 5% to this party. And in the second year as well, it is repeated. Third year also repeated. Fourth year also repeated. Fifth year also repeated. Fifth year, they exchange the two capital amounts back again to unwind their positions. So that is a currency swap. That is a currency swap. And what is non-deliverable forward or non-deliverable forward foreign exchange contract, meaning they work out the forward rate, and agree to exchange the difference between the forward rate and the transaction or market rate between the parties if they are affected between the two parties, like in the case of FRAs and then interest rate agreements we discussed in a previous slide. That's a non-deliverable forward. In the case of non-deliverable forward, the capital amount is never delivered. Only the difference between the contract rate and the market rate, calculate the difference and exchange between parties. That is non-deliverable forex forward contracts. So they help business entities like this to have agreement between them for non-deliverable forex forward rates or currency swap rates, and then benefit to each other. Yeah, cross-currency swaps are explained here. Example, government to government currency swaps. Example of a Euro USD currency swap for 2 years. Spot exchange rate is €1 equals USD 1.5900. Redemption in 2 years at today's spot rate 1.5900. Annual interest payments at 2 year swap rates USD 3.35%, EUR 5.15%. At the inception of the first date, New York Bank pays $159 million to the Frankfurt Bank. And the Frankfurt Bank pays 100 million euros to New York Bank, currency swap. And interest exchange at the end of each of the 2 years. Now on the 100 million of euro, interest at 5.15%, euro million 5.15 is paid by the New York Bank to the Frankfurt Bank. Then on the USD 159 million, interest at 3.35%, Frankfurt Bank pays US Bank, New York Bank, 5.3265. Calculation is 159 million into 3.35%, 5.3265%. So that is repeated at the end of the second year as well. And at maturity or the end of the second year, the $159 million is prepaid or returned to New York Bank by the Frankfurt Bank. And the euro 100 million is returned to Frankfurt Bank by New York Bank. So these are the cross-currency swaps. All right. We have left only 10 minutes to explain the interest rate swap. It may take a little more time. Therefore, can we stop here for today? The interest rate swap futures, and I think we have options contracts. To explain that, we will resume explaining those products on Tuesday 16th. On Tuesday 16th, shall we meet at 4 and explain? All right.